convene the Mendocino County Employee Retirement Association Board of Directors meeting to order. And Judy, could you conduct the roll call?
Yes. Ms. Schattmeyer?
Here.
Ms. Forrester?
Here.
Ms. Cavanis?
Here.
Mr. Jody?
Here.
Here. Ms. Smith?
Here.
Mr. Cromer?
Here.
Mr. Shoemaker is absent. Hopefully joining us soon. Ms. Harris?
Here.
Mr. Anderson?
Here.
Thank you. We also have some members of the Callan team present.
Okay, great. Jim, can you lead us in the Pledge of Allegiance?
Sure. I pledge allegiance to the flag of the United States
of America
and
and
to
to the republic for which it stands,
one
one
nation,
nation, under
under
God,
God,
indivisible, with
with
liberty and
and
justice for all.
All right, thank you. That leads us to public comment on items that are not on the agenda. Members of the public are welcome to address the board on subjects that are both on and off the agenda. And this is the time for people to comment on items that are not on the agenda or on the consent calendar. Do we have any members of the public that would like to address the board on items that are not on the agenda or on the consent calendar today?
I see no public comment at this time.
We have on the consent calendar minutes of the July 21st Board of Directors meeting and of the July 21 retirement report, along with the preliminary monthly financial report. Are there any concerns or objections to adopting those as part of the consent calendar? Okay, not seeing it, then they'll be deemed accepted by the board. Next, we have discussion regarding the Historical Benefit Review Project status report.
Thank you, Chair Jurdy. The status report is in your materials. We've completed the Alameda refunds. The notices have gone out last month. The checks will go out to active membership this month. We've also made a number of additional corrections. If you have any questions or comments regarding the report, I'm happy to address those now.
Julie?
Thank you. While I was doing my weekend reading for the retirement board meeting, I noticed that Fresno County Cerro adopted an intermittent service credit retroactive purchase agreement. And I was hoping that we could bring that back to the board and look at that. They interpreted the code, the Cerro and the PEPRA law to allow for the definition of operative, to allow for a back date, a retroactive date. And then they adopted it at the Board of Supervisors on May 11th. And so I was just hoping that we could bring that back to the agenda with the full board, look at that code section and see if we can go to our Board of Supervisors and ask for the same. We haven't hit this item number 4 yet. It looks like we have one review of the intermittent service credit. And I think that one for the prior purchase is the one where we couldn't find the record of the Board of Supervisors. The other prior purchase service credits appear to be a lot more clear, as one was revoked by the board. One is for contract employees and they have separate code sections. So I'm talking specifically about 31641.56, I believe it is. And anyway, the Cerro Council recommended to the Fresno Cerro board or Cerro board that they go to the Board of Supervisors and adopt this. So that would allow for those prior purchase service credits for any applicants to stand to date. So I want to bring that up and see if I can get any support from maybe our retiree member or other employee members here to review that.
Okay, I see a couple hands raised. First, Catherine, and then Richard.
You're muted.
I said mine was a completely different question, so I'm going to take it down until we finish talking about this question.
Okay, Richard, then Jim.
I fully support Julie's request.
Okay. Jim.
Julie, thank you for the research. And it was just a question is, do you know how that was handled? Was it specifically effective, historically from a particular date not to go forward? Or was it just kind of a blanket acceptance of a new interpretation of that code section?
What they did was go back retroactive to 1990. And then they, at the same time, revoked it effective December 31st, 2020. And that allowed for any applicant that had already made the purchases up through December 31st, 2020 to still be a valid purchase for calculation for their benefit. That date specifically, I don't know why they chose December 31st, 2020, but I would say that it probably was the last time an employee purchased the intermittent service credits. So I just think that their interpretation of the code is a little different, I think, than what we understood it to be. And they have some documents laid out, and I know attorneys can review and have different opinions, but I think it's worth something that we look at. This was just, I just happened upon this actually for the next board item related to the purchase correction methodology and that code section. And I was looking, I'll bring up my question on that item, but that's how I ended up stumbling across it. And it was very recent. It looks like their council recommended it May 9th, and it went to their board of supervisors May 11th, and it was adopted.
Thank you.
Okay, Jeff.
So I appreciate the trustee raising this issue. It's not something that I'm aware of. I don't know if our executive director is. So this agenda item is about an update on the project. And as long as we don't get into too detailed of a discussion, perhaps it's more appropriate to be discussed in the next topic. But as far as any substantive discussion of the issue, we'd need to look into it, and we could always bring it back at the next meeting. But perhaps the executive director has some information on it. I don't know. And so, Doris, is there anything you can add to this?
I was aware
Otherwise,
of
we
it.
can consult with counsel and see what they say.
I was aware of it. I did bring it to our fiduciary counsel's attention, and her opinion had not changed in the interpretation that she had originally provided to the board, that retroactive adoption is not permitted. That isn't to say that another attorney didn't see it differently, and that someone, Fresno chose to take that path, but our fiduciary attorney opinion is unchanged, that the serial does not permit this because of the adoption of the PEPRA provisions that restrict it.
So I still think we could bring something back to the board that maybe provides a little bit more detail and background on that issue. If it's two attorneys who disagree, or why, it seems, and we while we want to be transparent, we also want to be mindful of attorney-client communications. But I understand the seriousness of this issue and the desire of, if I can speak on behalf of the trustees and the board, that you do want to be transparent. So maybe this is an issue that we can bring back next month and see if we can have a little bit more of a deeper discussion on it.
I'll add it to next month's agenda.
Okay, thank you. Any other comments or questions about the historical benefit review project? Okay, Director Smith.
I am trying to find the right buttons, but there I did. Mine's are more general questions, but I also see Richard's hand still up. Is that regarding the last part, Richard?
That's new.
Oh, okay, all
I
right.
have another comment to the issue.
Okay, so just the first page of the report, I just had somebody in the public ask me a question about this the other day, and I didn't have the answer, so I'd like to get the answer. It says the total number of corrections are 2,015, and that we've completed 448. So those other 1,567, have those people been notified that there is something going to be looked at on their record?
That number will actually be coming down. That was a number based on our initial review of accounts after the IRS direction to make a couple of changes to how we were planning to proceed with the corrections, but also it includes the 2 new items that were added. Primarily, the largest chunk of those are inactive accounts that did not receive the semi-annual interest. And those folks will receive a correction notice once we get the interest posted and bring their account up to date, letting them know what their corrected account balance is. That also will involve contacting people who have already taken a refund but may have been entitled to omitted interest. So we have a process laid out to identify current addresses for folks who are no longer employed and had already taken distribution from the system. But that total number of corrections will come down because upon further review for a couple of the newly added items to the VCP, further review identified a smaller subset than we initially reported. We reviewed some accounts and found out that they were truly not affected, but that number was the gross number before we had finished all of that review, and we had to give some counts to the Internal Revenue Service. But we've eliminated quite a few, several hundred at least, as not actually requiring it. And some of them are issues like failure number 3 in the original filing had to do with retirees not having been offered optional payment allowances when they retired. We had proposed initially to correct that on a go-forward prospective basis. We are now contacting affected members to provide them the option of retroactively selecting one of those optional payment allowances.
Right.
Those folks have received, or almost all of those folks have received their notice. A few of them have actually requested calculations to see what the difference in benefit would be. But those, even though we've sent out notices to those numbers aren't reflected in the counts of people who've been contacted.
They don't see my ugly mug. Thank you.
So there are then a number of people who received a notice but have not received the details.
Just the original group, really.
Okay.
We have the original ones that said, you are affected. And then as we work through that group, that was about 530 some 8 people or whatever, we send them the specific notice outlining the correction and the impact to their benefit. Those were all retirees. This count now also includes active employees that may have a purchase issue or a refund of contributions due under the Alameda. So that number now includes not just retirees, but active and former members who had the interest issue on their account. So there are quite a few, I want to say it's close to 750 that have not received a notice. They will receive a notice when we apply interest to their account and get it brought up to date.
Okay, sorry, I'm digging a little bit, but that original 500 that got the original notice months ago, those have not all been completed. Is that correct?
That's correct.
Okay.
We still have at least a couple of hundred of those to do.
Okay, thank you.
You're welcome.
Thank you. Director Shoemaker, then Director Forrester.
Richard, you're muted.
Try that again. Thank you, Julie, for checking and following up on that Fresno issue. And I think we had something occur already with this, and that was the IRS determination that one of our correction proposals was not appropriate, and we've come back and changed it. So I think that rather than rely on attorneys, that we rely on the IRS to tell us about Fresno or what they've done, or if we would decide to take that route and let the chips fall where they may with the submission to the IRS.
We do have a compliance statement issued by the IRS outlining the proposals and correction methodology that we had previously discussed and was included in that submission packet. If we change anything, it will require filing a new VCP to get the change approved, because we already have a compliance statement for the methodology that was approved by the IRS.
So does Fresno have that? Do we know? We'll
Fresno
find out at the next meeting.
Did not open a VCP.
Uh-huh. Okay, well, all that stuff will come at the next meeting. We get another report, I believe.
Yeah, so I can bring additional information back next week, not next week, next month, regarding what Fresno did and where we stand with our application. Well, we actually have the compliance statement, as the board's aware, on our current application.
And one other question to this issue, on the letter about the choices for calculation, this new correction that has so many, is that basically the entire membership?
No, it does include several, former members. I don't know if it's 100 or 200 or something. There are active employees who were not affected by Alameda and people who had multiple corrections. So just because there's 200 individual accounts or errors listed there, it's not representative of the entire population of our system, which is about 3,000, but it is a significant portion.
Yeah, that references to the number 2,000, I guess, and thank you very much.
Director Forster.
So I have two comments, I suppose. Number 4, correction, is it possible that we hold off? I don't know, Doris, if you're doing any of those next month, if we can hold any of those corrections till the board can have a discussion next month on the review of the purchase service?
If you change the direction, it will likely require we file a new application for voluntary correction with the Internal Revenue Service, because we already do have a compliance statement. The compliance statement that was issued on June 30 only provides us with 150 days to complete all of the corrections, and we will likely be requesting an extension of that, but this would potentially cause additional delays in completing the project. Because we had been holding off on the purchase corrections, ready to move forward with those, and are starting to actively work those now. The retired and active, I believe, folks, total number of members affected by a purchase correction is approximately 120 individuals.
Okay, so I'm just asking that it get shuffled past, like you move to a different item to correct this next month, and instead of that, so we have the opportunity to review it at the next board meeting before that item is addressed.
We can, and the purchases issues that we're starting with were actually not deferred status purchases, which is the specific code section that you're referencing. So we can go ahead and move forward with those that we have in progress, because they are not a deferred status issue.
Okay, thank you. And then my understanding when I was reading the VCP and the IRS response to our item number 4 was it stated that the applicant determined that we couldn't do this, and it referenced it over and over again. It didn't say the IRS agreed with the applicant or that the IRS determined it. It said the applicant, which is us.
Right, that was based on fiduciary and tax counsel, sorry.
So we can, I mean, I don't want to get into the weeds on this too much right now. We can do it next next month, but I don't think that just because we have a VCP with a response, the response was based on what we fed to them and what was our understanding at the time. And so I think it's worth correcting the VCP if that's necessary.
Okay, Director Cromer.
Thank you, Chair. I have two questions. The first one, I hope, is a simple one. The total number of corrections in 2015, Doris, is that referencing corrections for each error or members? Because I think that goes into what Richard was talking about. And it's obvious that we know that certain members can have numerous errors in their membership in their account. So
It's technically started out as members and is intended to reflect members. However, because several errors were added after the initial counts and they were tacked on as a separate, we do have some folks who are now listed twice because we had already done a correction and now we have a correction for the new item that was added. So there are a few duplicates, but for the most part, those are individual and unique members. That number will be coming down by several hundred because on the option 3.4 issue, as an example, where they weren't notified of the optional payment methods when they retired, we originally thought that that might have affected 554 people, and upon further review, we brought it down to about 381, if my memory serves me correctly. So that number is still slightly inflated because it was based on our initial projections, and it has come down a little bit as we realized that some people were truly not affected by an issue.
okay, yeah, yes,
it was intended to be people.
Okay, got it. The other one, I know that we're trying to stay in our lane with the HBRP right now, and I think this does relate to that, but just to be clear on the Fresno, this is specifically relating to a deferred status purchase, and we have many other purchases that have been determined of not being allowed in our system that would not be changed regardless of what happens with this Fresno, correct?
That's correct.
Okay, I just wanted to be clear to people listening here that if they may have gotten a notice saying the purchase that they may have made that was not permitted in our system, that this discussion we're having right now only applies to a very specific faction of people that made a deferred status purchase.
And when this item comes back next month, I can give you a better quantitative of how many people have a purchase issue and how many of them are actually affected by the specific deferred status item.
That would be appreciated, because I know people watch this, and I know that we all get questions, but I know that some people may be listening to this, and if they got a notice saying that they had a purchase that was not permitted, I just want people to be very clear of what we're talking about, that it's not every purchase that was not allowed. It's just a very specific purchase.
That's correct.
Thank you.
Okay, if we have no more questions from board members, do we have any members of the public wishing to discuss this item?
I do show one public comment. Kendall Smith, are you there?
Yes.
Right, you may start your public comment.
Thank you, Judy. Just a brief comment to Trustee Forrester's comments regarding actions in Fresno County. I think it would behoove Sarah to look at your own employee memos, historical memos, because under a public records request, there was a memo, and I don't have it in front of me right now. I believe it was 2017 or possibly 2018, but a staff member actually recommended this very action that is now being discussed. And it was in a written memo by staff when looking at the complexity of the errors and the challenges with the deferred status purchasers. So I think that memo ought to be included in your discussion for next month. Thank you.
Okay, well, this item will be coming back to the board at next month's meeting. If there are no other comments on the historical benefit review, we can move on to item number 4, which is the discussion of the purchase correction methodology.
Thank you, Chair Jurdy. This item was brought forth at Trustee Shoemaker's request, and it covers the correction methodology. As Trustee Cromer had previously stated, there are a number of different purchase issues that have corrections laid out in the VCP application. This correction methodology applies to the majority of them that were not permitted because it was not allowed by the CIRL, and that Mendocino County Board of Supervisors had not adopted a specific section. For the errors that occurred, which were on a permissible service type that may have other remedies to correct a deficiency, are not covered in this memo. This really just has to do with the planned process for correcting the invalid services that are not permitted according to the code. So it's a process that involves about 4 steps. We first recalculate the retiree's retirement benefit to see what their benefit would have been without the purchased service. And we use that to determine the amount of overpaid benefits. Then the amount that the member had paid is adjusted with interest at the member's crediting rate from the date the purchase was completed to the date of the member's retirement. That value, an interest adjusted purchase value, moves forward at the point they retire and is credited with interest at the actuarial assumed rate of return, offset for the specific overpayment for each month they were in retirement. There was a simplified example in the illustration in the memo for you. Additionally, the process to correct an active or deferred member is similar, but there is no adjustment because they have not begun to receive benefits. So we calculate an interest adjusted value of their purchase contributions and then refund that money to the member, removing those service years from their records. So when they do retire, their pension is based on the appropriate years of service. So this was what was laid out in the VCP from the beginning. There wasn't really any changes to this purchase correction methodology in our VCP application. And I'm happy to answer any questions regarding it. Richard, did you have specific questions since you had asked for this item?
So the one question I have at the moment is, in all other cases of overpayment, we've only recovered the prior 3 years to the date of the discovery, right?
There was no recovery from a retiree regarding overpaid benefits. Overpaid benefits were essentially counted as part of the unfunded liability. But retirees, no retiree was asked to repay overpaid benefits relating from the initial VCP corrections, with the exception of the Alameda corrections that we did not get completed prior to September. So we do have a few folks in the very first part of that benefit report that shows a very small amount of repayment, and that was just 1 month's worth of benefits after the implementation of Alameda, and we were still working on getting the retiree Alameda items corrected. But for everyone else who is retired, if they have been overpaid, they have not been asked to repay Sarah.
Okay. And so in this formula, the basic issue that we're hearing about is the continuance of payments at the levels, request to keep the deposits in the account and to continue the payments rather than, quote, cash them out and make a deduction.
That would be a separate issue for September discussion.
Okay.
But I bring that up because the invalid purchase types hadn't been adopted by the Board of Supervisors. The reason they're required to be adopted is that the employee is not paying the full cost of purchasing that additional service. That purchase is inherently subsidized by the plan sponsors. With that though, because in these instances, we were looking at giving money back potentially to a member who had also then been overpaid because of the correction, these essentially would net that overpaid value of the purchase contributions with interest being offset for the amount of overpaid benefits.
Okay, thank you. And so in the case of somebody that just has an overpayment that is stopping, what they got overpaid over time on a miscalculation was subsidized by the system as well. Is that correct?
The overpaid benefits unrelated to the purchase issues, as you were mentioning, are being accounted for as part of the system's unfunded liability, and in that regard are being subsidized by the system and our plan sponsors.
Okay, thank you. That's all I got. Thank you for this report, and I'm sure some public members will have questions.
Okay, thank you, Director Forrester.
And when I was looking at this, I was more thoughtful about the tax consequences and how the purchases come in and how are you reporting it back to the retiree or member. So say had these prior purchase of $24,000, that may have come through a rollover, or it could have come directly out of my pocket on a pre-tax that was already taxed.
We take that into account when a refund is issued. If the refund is due, the letter would allow them to potentially roll that over back to another tax qualified account if it was pre-tax monies, meaning either that it was a pre-tax payroll deduction or a roll in from another qualified retirement account. After tax monies go back to the member as an after tax distribution. So because they had already paid tax on it on the front end, it isn't taxed on the second time when we distribute it, just as it wouldn't be in someone's pension benefit. Pre-tax monies make a pre-tax benefit that is then taxed when the members received it. If we got after-tax money, it's accounted for as a portion of their benefit that is essentially non-taxable because they've already paid the tax on those contributions. The after-tax monies would be paid back, classified as being after-tax. Any interest granted on it that is refunded is a pre-tax amount though.
So I guess, I'm sorry, that was pretty quick. I didn't get all that. So are you saying you'll send that on a 1099-R, or what kind of form, and you'll report separately what's taxable from what's not taxable?
We do that all the time now currently also, as far as someone's monthly benefit or a lump sum distribution. It's broken out whether or not it is a taxable distribution or if a portion of it is non-taxable. So the member will be notified if they have the ability to roll it over because it is pre-tax. And yes, the 1099-R that is issued for the tax year would indicate the tax basis of the distribution.
So for an active member, because it looked like in your example, there were some active members that had these purchase service credits. And so assuming that no changes made for this conversation, and they haven't received retirement benefits because they're an active member, how would it get reported to them, I guess?
They will receive a 1099-R for the partial lump sum distribution, again, reporting whether or not it's taxable or not, or which portion is, and they would have the potential also to roll that over if it is pre-tax monies.
Okay, thank you.
Okay, do we have any members of the public who wish to comment on this item?
You're muted, Julie. Judy.
To public comment. Terry? Ms. Terry Gross, are you available?
Yes, good morning.
First, I would like to thank Trustee Forrester and Cormer and Richard Shoemaker for some engagement and review of these historical review issues that I really haven't heard before. And then I want to remind the board that there is a subset of individuals who did purchase service credit, whose purchase included not only their share of the purchase time, but also what their employer, what the county would be paying. So you have retirees who for X amount of time are paying both their share of the benefit and the county's share of the benefit. So there's no subsidizing going on. I don't know off the top of my head how many of us there are, but we are there. And that is my reminder. Thank you.
Okay, next up, Kendall Smith. You may speak.
Thank you, Judy. Several comments here. Basically, I'd like to go over some historical concerns. Basically, there are three error groups in the HBRP: underpaid, overpaid, and those that purchase service credits, who are truly not overpaid. Real harm will be done if the benefits from those service credits are removed, and this is the member group of most concern. I believe you've tried to accurately deal with the underpaid population and the true overpaid, and I've followed those adjustments, and I concur with most of them. My concern is that each and every trustee needs to fully understand the purchase error group complexities, and you have a fiduciary responsibility to understand these issues and not rely on counsel and your ED without your own complete understanding. Over 100 retirees relied on MSERA to oversee the plan funds and to execute the purchase of annuities accurately and in accordance with the CERL. According to your documents and the purchase errors, they span more than 4 decades. This dates back to, I believe, your earliest date in your IRS document was 1979. There were at least 5 plan administrators during this period of time. The time span requires an explanation. Where was the administrative oversight? Were these just the cumulative errors of well-meaning employees or known breaches of legal compliance? I think the record will show it was both. Clearly, this is fiduciary negligence and a breach of fiduciary responsibility. With the prior overpaid groups, you clearly did not follow item C that is in your August 18th memo. You simply stated, as Trustee Shoemaker reiterated, that this would be passed on to the plan sponsors. So overpayments were not sought to restore the plan as referenced in item C. With regards to those that purchased service credits, there was a guaranteed life benefit on the purchases, or they would not have been made. Your methodology presented in the August 18th memo places the burden of your collective errors over 4 decades directly on the retirees. You need to shift this responsibility back to MSERA as the fiduciary responsible party. This might be in the form of continuation of benefits or payments as damages. The breach of these contractual agreements is yours. Thank you.
Okay. If there are no other comments on this agenda item, we will go on to item number 5, which is discussion possible action regarding the investment matters. Director Shoemaker.
I think everybody should get that statement from Kindle and writing and read it and think about it very clearly. Thank you.
Okay. I think we are now ready to go on to the investment matters. Greg, are you ready to present?
Yes, thank you, and it's good to be with you again. We have a couple agenda items to talk to you about today. The first is to talk to you about performance through June. We have our full report, and the punchline is that returns are very strong in absolute terms, relative to indices, and relative to other plans. So it's a very solid June performance report. We could also briefly touch on the monthly report, but there's not as much news in the most recent month report. After we cover performance, we have Mark Wood, a member of our research team and a member of our ESG focus group, who is going to provide an educational session on ESG. ESG has been very topical. A lot of asset owners like yourselves are looking into it, thinking about it. And so we are bringing this presentation at your request, very much as an educational session. There are not necessarily action items at the end of that session. So I'm going to provide a quick overview of capital markets. Claire is then going to talk about plan performance. And then Mark is going to talk about ESG. And then along the way, Hannah, who I think you all have met in the past, Hannah is going to be sharing her screen. And we're going to start off with the performance report. So hopefully, Hannah, you can do that. There we go. Full screen mode. There we go. Wonderful. Okay. So I'll go through this part fairly quickly. But what we're showing on this chart is the return of the U.S. stock market during the last three major downturns. Last year's COVID-19 drawdown, the global financial crisis, and the tech bubble, which is about 20 years ago now, hard to believe. And what this chart shows is that the COVID sell-off was the quickest we had to reach a bear market, down over 30% in the first quarter of 2020. And it's the fastest to recover as well. And as of yesterday, Mark Wood just pointed this out to me. As of yesterday, if you bought at the bottom of the COVID sell-off, you would now have made 100% since the bottom and back to today. So it is truly extraordinary. And there are a number of things propelling the stock market up. Monetary policy, fiscal policy, and the fact that while in aggregate, people lost jobs during COVID and people's individual incomes may have gone down, if you look collectively at the United States, because of the transfers from the federal government, aggregate income did not drop during COVID. And so a lot of this income went into savings, which has since gone into investing in the stock market. On the next slide here, we have a few of the macroeconomic indicators we often look at. Now, in the long run, these macroeconomic indicators are the things that drive markets over the long run. So real GDP growth on the left-hand chart here, you'll see that over the last 2 quarters, we've been hitting GDP growth rates of 6 to 6.5%. So it's truly extraordinary growth rates. But what's more important than the GDP growth rate is the absolute level of GDP. Because we had such a strong downturn in GDP during the COVID issues of last year, strong growth rate over the most recent quarters is really just getting us back to where we were before. Now, on the right-hand chart here is something a lot of people have been talking about, and that is inflation. And without doubt, it's been one of the top issues that investors have been worried about. So PPI inflation here year over year is up 20%. PPI is always more volatile than CPI, but it is eye-popping. CPI up 5.4% through the second quarter as well. Overall, we're in the camp, Callan, that this is largely transitory and due to kinks in supply chain. So we think over the long run, inflation will come back down closer to the long-term average that the Federal Reserve is expecting, and that's priced into the market. So if you look at the bottom chart here, the break-even inflation rate, the yellow line there, is telling you what is priced into the market in terms of the bond market's expectation for inflation. And that break-even inflation rate is running at around 2.5%. So it's not the 5, but it's not 0, right? It's a moderate, it's 2.5%. So that's falling more in line of what kind of the long-term average expectation is for inflation. Let's flip ahead, if you will, to the next slide. And here's this, this reinforces the comment I made earlier about GDP growth rates. So we had 2 consecutive quarters of GDP of 6 and 6.5. But what this is doing, it's really just pulling us back to where we were right before COVID struck. So in the glass half full perspective, we are growing at 6 to 6.5%. On the glass half empty perspective, what this is saying is all we've done is gotten back to where we were, and oh, by the way, it's a year and a half ago. So we really haven't grown a lot over the last year and a half. Now, when we look at these numbers, they really show what's going on to the overall economy across the United States. If you look at the next slide here, this is more about what's happening to individuals. So we've talked about this in the past that, we can talk about the averages, but individuals are what are really impacted here. And what this is showing is the employment rate for different sectors within the economy. And since February 2020 to where we stand roughly today, leisure and hospitality industry still has 2 million fewer jobs than it did a year and a half ago. So there's still a long way to go in leisure and hospitality. Local government, I thought this was really interesting, might be meaningful for you as well. Local government has lost 800,000 jobs over the past year and a half as well. And then the federal government is flat. So while because of the massive amounts of fiscal and monetary support, aggregate incomes are good, but individual balance sheets, if you look at individual people, they may not be as good as they are right now.
Director Shoemaker, you have a question or comment?
Do you have this chart somewhere in percent of the category?
You know what? We can dig that up. We'll dig that up and send it over to you. This is coming from the Department of Labor statistics. So we'll figure that out, Richard.
Thank you.
I think it's kind of remarkable that the local government is the second largest sector in terms of job losses. State government's up there too. Here in California, that's not really been the case. I mean, the state, I think, didn't have furloughs. County of Mendocino did not have furloughs. There were some local governments I'm aware of, like City of Fort Bragg instituted furloughs, but it seems to be more of a situation outside of California.
Yeah, California economy, I mean, it's a unique economy, and it's been extraordinarily resilient. I'm going to flip ahead to slide 9, and here we have returns for the broad capital market categories. And the big takeaway here is for the quarter ended in June, nearly everything was up and up meaningfully. For the 1 year ended June, we also see really strong returns, but keep in mind at the starting point there that we're really looking at all of the rebound after the COVID sell-off. So very strong returns in the US and international stock market. And then the bond market is the most recent quarter positive because interest rates came down a little bit and pretty much flat over the last year. And in the interest of time, maybe we'll flip ahead and start talking about the MSERA plan on page 16, and I'll hand it over to Claire.
Sure, thank you. So shifting focus a bit, like Greg said, to your plan specifically, the MSERA investment portfolio certainly benefited from the strong returns that we saw in the markets in the recent quarter. But even more notably, June 30 marks the end of another fiscal year for you. And it was quite a remarkable fiscal year. Greg pointed out the recovery since the end of March. And on page 16 here, we captured total plan growth for your investment portfolio. And if you look just to the far right, you see the effect of that rebound on your total plan assets. So the recovery since the end of March 2020 has been about 5 quarters, and 4 of those are the most recent fiscal year for your plan. So not a surprise from that, that we saw a pretty remarkable return for the full fiscal year. The bottom half of this page focuses on the numbers related to that fiscal year performance. So your plan started the fiscal year, June 30, 2020, with about $538 million in assets. Saw investment returns to the tune of about $167.6 million, with every asset category posting a gain over the year. You paid benefits of about $10.5 million, and then ended the fiscal year with just shy of $700 million in total assets, so a new high water mark for the plan. A few things to point out here in the bottom half of the page in terms of what we saw in the portfolio over the course of the year, and much of this are things that we've talked about in previous quarters meetings. But within that net new investment column, you can see a couple of rebalances that occurred over the course of the year. Effectively executed, Robert did a good job of rebalancing the portfolio out of equity as equity has continued to run hot, and into fixed income, which became underweight as a result of that. The other thing to point out here in that net new investment column is that the new infrastructure mandate was funded in the recent quarter, in the second quarter of 2021. And so you see that line item, one of the 2 infrastructure managers that you have committed capital to called, and that's JP Morgan, called capital in the most recent quarter. So that line item does show up here now. Moving on to slide 17, this looks at actual asset allocation of the portfolio as of the end of June, as compared to the target. And not surprisingly, especially with the rebalances that did occur, the portfolio remains right in line with that strategic target allocation. Importantly, you can see the small percent differences on the bottom second from the right. All of those are within the range of the tolerance bands outlined in your investment policy statement, so no concerns there. Page 18 looks at asset allocation in a bit more detail. So all of the broad asset categories And then within that, each of the individual managers, how assets are allocated to the individual managers within the plan. Importantly, balance does remain in the portfolio as you have designed it, between growth and value, for example, within different asset categories, and amongst developed markets and emerging markets within international. Your 2 fixed income managers also remain in balance, as is true for the 2 real estate managers. Looking just specifically at this quarter, and the very bottom line, the portfolio saw investment gains in the recent quarter of about $34 million in total, again, with every asset category contributing to gains. With outflows to pay benefits of about $3.3 million, again, the total portfolio ended just shy of $700 million as of June 30, 2021. So no concerns from our perspective on asset allocation. Implementation remains in line with intention from the board and the strategic target. Getting to page 19, we see returns for the total portfolio. So I mentioned that the total fund was up about 5% in the recent quarter, 5.1, slightly behind the total fund benchmark return of 5.6. And then for the full fiscal year, up 31.75% versus 27% for the strategic target. Longer term returns are all very strong in both absolute and relative terms. Greg noted that the fiscal year return certainly marks a unique time period, capturing much of the recovery that we've seen in the last 5 quarters. But importantly to me, including that downturn, the trailing 3, 5, 7, and 10-year returns are all very strong annualized positive returns. For the last 3 and 5 years, again, including that pullback in March of 2020, up over 12% annualized for each time period.
Director Anderson.
Thank you. I have a question, and I don't know if this is something that Callan has discussed with the board, as I'm still in my first year here, but as I look at these returns, and I just completed the Sackers Berkeley Haas School, and there was a lot of discussion about investable benchmarks. And as I look out in time and I see the kind of the condensed bars there and how close our investment returns are to the benchmarks, I'm just wondering, what whether or not there's been much discussion of that, and whether or not it may be something that would be appropriate. If not, would be appropriate for an educational item going forward. Thank you.
Sure. So and anyone jump in here if I'm missing the question. In terms of investable benchmarks, the majority of the indices in your total fund benchmark are investable, are public equity and public fixed income indices. The only one that's not directly investable would be the real estate benchmark, which is also applicable to your infrastructure allocation. To the distribution of the bars here, you make a really good point, Jim, that as you get out over longer time periods, that peer group distribution, which is what the gray bar represents, does narrow. That is, though, compared to the most recent year, where returns have been outsized and the dispersion itself has been outsized. So if we actually took the last year off the page and just looked at 3, 5, 7, 10, and 15, I think those dispersions would look wider. Importantly, your plan over time has continued to perform at the top of that peer group, the peer group itself not being investable, but has pretty closely tracked the benchmark, and over longer time periods has outperformed net of fees.
This is a question for Claire or Greg. Has Callan ever compared, say, MSERA's performance versus some of the larger entities like CalSTRS, CalPERS? I've seen some recent reports from CalPERS, and I think we did outperform CalPERS in some recent returns.
I personally haven't looked at, Greg, go ahead.
Yeah, I was going to say that we haven't produced that report, but I think through Stackers, I think they publish a report annually. Maybe RVK used to do that, and they would list out the individual plans that they collect data from. Anecdotally, I've been just reading the press. A lot of people are publishing their fiscal year June numbers, and you see a lot of 20s to 27% sort of returns. So your 31% return would be, exceeding those. And as we've talked about over the years, the fact that we invest primarily in public market securities, that's certainly benefited us quite a bit, as opposed to plans that might be investing more heavily in illiquid asset classes and other diversifying things like hedge funds, which really have not kept up with expectations. When I look at this chart, I kind of think about it two ways. One is, so what the green triangle represents in the policy target, that's the asset allocation decisions we have made, right? The policy target represents, okay, the asset allocation decisions we have made. So how well is that triangle ranking? And then the blue dot is, okay, how do we implement relative to that triangle, right? Picking managers to beat that. So there are really two questions that we're looking at there. How well did our policy target do, which is our asset allocation decision? And then how well does the blue dot do, which is, okay, how do we implement around that target? And these are all net of fee returns, is another thing to point out. While the distribution narrows over time, over the last 10 years, you'll see that let's just look at 25th to 75th percentile. That's 1.8% different per year in the middle quartile there. So 1.8% for 10 years, and so that's a 20% cumulative difference when you look at compounding there. So you could have either 20% more or less dollars over that 10-year time period if you look at it that way. So it's pretty meaningful.
Okay, thanks. Didn't mean to interrupt the flow of the presentation.
No, thanks for the question. Any other questions on total fund performance here on slide 19 before we move on? Okay. In the interest of time, I'm going to skip ahead to slide 23, which looks at the last 1 year return of the total fund versus target and 5-year return, annualized return of the total fund versus its target. To break down attribution, what's driven outperformance versus your target in those time periods? So the last 1 year being the recent fiscal year, and manager effect circled in green is what's really driven outperformance versus target. So that's the active implementation of your strategic target that Greg was talking about. That's your active managers. It's also any active tilt. So you have a strategic overweight to small cap versus the Russell 3000 within domestic equity. In aggregate, those implementation decisions added 4% to relative returns in the last year. Over the trailing 5 years, similar in that the manager effect has driven outperformance versus target over the last 5 years. And one thing that jumps out to me for both the 1 year period and the 5 year period is that the international equity composite, which had been the most challenged portion of the total portfolio just a couple years ago, has really done quite nicely. Had a great year last year, came back strongly. As you all know, the board did take a deeper dive look at that asset category composite and the individual managers within it, and decided to hold on to the existing construct, and that's been a good decision in the last year. And then wrapping up here on slides 24 and 25, we have individual manager and asset category performance for all of the underlying pieces in the portfolio. And starting on page 24, we looked at just the domestic equity portfolio. So the domestic equity portfolio was up 7.4% in the last quarter, just shy of the Russell 3000 index. For the last year, up 48.5% versus 44% for the Russell 3000 index. Longer term returns are very strong in absolute terms, all greater than 10% annualized. Over the last 5 years, the domestic equity portfolio has returned over almost 19% annualized. And when you look at returns versus the Russell 3000 index, quite strong, keeping up in most time periods. One thing that I mentioned a few minutes ago was the slight overweight, strategic overweight to small cap, which you reduced last year in the reevaluation of the domestic equity portfolio by pulling out that equal weighted S&P 500 index fund. We would expect small cap to have an active or a premium over time to large cap. But if you look at the capital market returns for recent time periods, small cap has underperformed large cap. So that's been a slight headwind to relative performance for the total domestic equity portfolio. Overall, the managers continue to perform within expectations. Returns for the trailing 1 year, quite notable in absolute terms. I did note for the recent quarter, the Janus mid-cap growth return versus benchmark does stick out. But if you look back just 1 quarter, they actually outperformed by over 5% in the previous quarter. So the mid-cap growth market segment has experienced some periods of narrow leadership in recent quarters, and that was a headwind to them in the recent quarter. So a handful of specific stocks that were headwinds, they have reevaluated and maintained conviction in the majority of them. If you look at even just the recent 2 quarters together, so the year-to-date period, that fund's performance has actually done quite well versus peers and versus that benchmark. So no concerns from our perspective there. The other fund I'll point out in the domestic equity composite is the Prudential Small Cap Value Fund, just because that is a pretty deep value-oriented strategy, very small cap, very deep value, and had seen pretty significant headwinds from the previous year. So we were pleased to see it perform well over the trailing year, up 89% and well ahead of its benchmark. On page 25, we have performance for the remaining asset categories. So international equity at the top. I mentioned this when we were looking at attribution, but the international equity composite had a fantastic year, up 44% and well ahead of its benchmark. Pleased to see active management coming through for those managers in aggregate within your portfolio. Domestic fixed income, no concerns there from our perspective either. Dodge & Cox and PIMCO remaining good complements to each other, have continued to outperform the Bloomberg Barclays aggregate over time, most notably posting a positive return over the trailing year versus a negative return for that benchmark. We do have the first quarterly return for your infrastructure investment. JP Morgan did post a positive return for that opening quarter. And that performance history will, of course, build out over time as that investment remains in the portfolio for longer. And then real estate continues to hold its own, posted a pretty notable 3.5% return for your portfolio in the recent quarter, up 5%, 5.2% for the trailing year, and an annualized 5.1% over the last 3 years. You heard from Reef and Barings at a recent quarterly meeting, and we think both strategies remain good complements to each other within your portfolio today. Total fund performance, again, at the bottom of the page here. This is what we've already looked at, but 5.1% for the recent quarter, over 31% for the last year, and the longer 10-year annualized return up 9.2%. The remaining pages just look at each asset category versus peers and benchmarks again. But in the interest of time, I'll pause here for any questions and before we turn to the ESG focused discussion.
Thanks, Claire. Not seeing any questions.
Okay, great. Okay, so Hannah's going to pull up the next presentation, and we're going to hand it over to Mark Wood. And so this is educational in nature. And before Mark gets started, I do want to remind everyone that the current situation for the plan. So the plan now invests in pooled vehicles across the board. So mutual funds or different trusts. And in so doing, you don't actually have control over the guidelines within the mutual fund or trust. So let's say, for argument's sake, you wanted to, you wanted to exclude a certain category of investments. The way we invest now, we don't have the ability to do that because we invest in mutual funds. The mutual funds are governed by their own fund documents, not what we wish they invest in. If we ever don't like what we're doing, well, we simply fire them and, put the money somewhere else, right? But that's the way we're structured right now. And I just wanted to provide that framework before Mark starts talking from a high-level perspective about ESG and what some other investors are doing about that topic. So with that, Mr. Wood, you are up.
May I ask a question real quick, Greg?
Yeah, sorry.
Would that statement you just made, does that apply to the infrastructure as well, JP Morgan infrastructure?
Correct. That's a, yes, that's a pool investment as well.
Okay, thank you.
Yeah.
Great. Thanks, Greg, and appreciate everyone taking the time this morning. We have, a presentation here. I think the first half is where I will focus a lot of my comments, but the second half are actually excerpts from our ESG plan sponsor survey from 2020. We're actually working on the 2021 survey right now, and we'll have those results into Q3 and Q4 towards the end of the year. So looking forward to updated information on that. Myself, I've worked on our ESG committee for 7 years here at Callan, so I've watched the progression over time as this has taken up a lot more interest from both the asset manager side as well as the plan sponsor side. So we've seen a lot of developments over time, and we can touch on that as we go through the presentation. Essentially, we're just going to go through a real high-level discussion of where ESG started, why it's all of a sudden been a topic of mind, and how that's being applied by investors and asset managers for different goals, different plans. So happy to take any questions along the way. But starting out, I think it's interesting to frame a discussion of ESG. It's really top of mind lately, but it's actually been around for a very long time. Just touching on a few waypoints here, all the way back, pre-1700s, you had Sharia law, which prevented the payment of interest and the collection payment of interest for Islam going way back. I think one of the interesting waypoints was in the 1750s when you had the founder of Methodism actually give this famous sermon talking about the social tenets of investing, really establishing the S criteria that we're talking about with ESG, really talking about good business practices with your neighbors, don't be a cheat essentially, and try to avoid working in industries or funding industries that would have harmful effects on the people that worked in them, which at the time were tanning and chemical production and actually whaling. So to give you a sense of how far back that goes. As we go through time, progress was slow, but as you can see, there were actually some interesting touch points in the 1860s. This, I think, is one of the interesting divestment stories out there. Wake Forest University, the endowment, actually divested of all its US Treasury bonds as the Civil War began and reinvested all those proceeds in Confederate bonds. As we know, the North prevailed, the Union was whole. Those Confederate bonds ended up losing, pretty much all of their value by the end of the Civil War in 1865. So the Wake Forest endowment had to start at 0 again. I think it's interesting though, because at that time, I think the endowment was $1 to $2 million, but compounded over the subsequent 170 years, that turns into a really big number, even at the typical 10-year treasury rate that the US government had. If you go to the next slide, Hannah. I think really the modern ESG era, though, began in the 1970s. Milton Friedman, actually famous economist, he argued that social responsibility was an adverse effect on a firm's financial performance, and that firms should just be solely interested in maximizing profits for shareholders. So I think this ethos actually drove a lot of the sentiment coming out of the 70s, 80s, and 90s as to how companies were operating, how shareholders were considered, and sort of began, what would be considered the shareholder era in the equity markets. However, kind of at the same time, you had a lot of these developments happening across industries where, in South Africa, there was a lot of discussion about apartheid and companies that were a part of that. In the 80s, you had a lot of environmental disasters that took a lot of the public attention, including Bhopal gas disaster in India, Chernobyl in Russia, as well as Exxon Valdez near Alaska. So you had kind of these two competing forces coming together, public consciousness about how companies might be impacting the world, as well as this idea that companies were solely dedicated to maximizing shareholder profit. Every other factor is less important. So you had these kind of two ideas, but it really came to a head in 2004. United Nations actually published this big paper about who cares wins, and actually coined the term ESG at that time. So jump ahead again, Hannah. So the modern era we've had in the last 15 to 20 years, it's really accelerated. And this actually coincides with developments in technology and data reporting. In 2005 and 6, you actually had the UN develop, based on those research and findings from those papers, the UN Principles of Responsible Investing, or the UN PRI. This has become one of this kind of credentialing and standardized organizations in terms of how asset owners, asset managers, and even consultants are, reporting on their different ESG practices. Callan's actually in the process of becoming a signatory right now. We just completed the first round of documentation, so we're waiting for comments on that, and I should hear back by year end or early next year to become a signatory. But over time, you've also had a lot of developments in terms of academic research, as well as kind of the famous COP21 from 2016, where everyone agreed to reduce carbon emissions with the goal of meeting a 2.5 degree Celsius warming trend goal over the next 30 to 40 years. So a lot of developments have happened, but as you'll see in the next slide, a lot of this has been driven by improvements in technology. So Bloomberg terminals, kind of ubiquitous on asset management and Wall Street, were actually first established in 1983. That was when they were first launched. In 1994, you actually had the first electronic dissemination of financial reports from companies through the Edgar portal online. In 1987, you have the launch of the Global Reporting Initiative, which was helping to standardize what the actual corporate disclosures were related to sustainability. And as you can see, those disclosures have increased pretty exponentially in the developed world, as well as some of the emerging markets. This most recent data is from 2017. But you can see that over 83% of the companies in the US are reporting some sort of corporate responsibility in their reporting, and over 78% in Asia, 77% in Western Europe. So this is a trend that's been driven by a lot of data and the ability to analyze that data and for companies to report on that data. So I think that's why we've seen a huge uptick in what is considered ESG over the last 15 to 20 years. If you jump to the next slide, Hannah. I think it's also helpful to frame the discussion broadly as to what does ESG mean today and what does it mean in the context of your plan and asset management in general. The pillars themselves, ESG, are environmental, social, governance. Environmental is pretty straightforward, generally related to how companies or different entities are using their resources, what kind of carbon emissions they have and how they're measuring those or mitigating those. How their company manages different hazardous waste and waste spills potential. And what we're really looking at here from an investment perspective are the different opportunities for environmental. That's like looking on a go-forward basis of how do we improve the efficiency of operations? How do we reduce the materials we're using? How do we more efficiently extract materials out of the ground? Or how do we better recycle and reuse those materials? And consequently, we're also looking at the risks. What happens if there's a huge reduction in the use of carbon and you're invested in an oil company? What does that mean for that investment? How do we look at that and sort of price that appropriately? What are the potential litigation costs if you do have a hazardous spill or have some chemical that's harmful? I think, most recently, Johnson & Johnson had to recall a sunscreen because there was some benzene exposure in one of theirs. So that's kind of a typical example of where some of these environmental factors are coming in. What might be harmful to consumers and is produced by this company, and how might that be a risk to company operations going forward. The social factor, the S pillar, I think that's also taken a lot of press and headspace in the last year or two, particularly as it relates to diversity and the composition of different workforces at different companies, different pay policies. So this is really related to factors of how this company is interacting with its different stakeholders, be it employees, the consumers of that company's product or service, and the communities in which those companies operate. So really the opportunities there, I think this area is a little less straightforward in how it's measured, but a lot of firms are trying to find ways to look at this. But the opportunities here, are employees happy? Is this considered a good work environment, an equal work environment? And how does that relate to the bottom line of a company's operations? The risks in this area are certainly reputational in nature. How do you price that risk in if a company treats its employees poorly? Does that cause a company to be fired as a supplier if different customers don't feel comfortable working with them? So these are all the considerations when evaluating companies as to how to price in both those opportunities and risks as it relates to social factors. And I think what we're seeing even from BlackRock and some of these larger institutions is they're pushing harder on the companies they own to better disclose, different levels of diversity within the ranks of the companies that they own, as well as how the pay equity looks into those different companies. So I think another area where data is going to be important, but we just don't have a lot of it at the moment, but there is a big pressure to disclose more of that going forward. Finally, governance. I think this is probably the most intuitive of the E, S, and G factors. It's related to kind of the structure and system in place to ensure the company is run in compliant and legal way. It also relates to corporate culture, the incentive alignment of employees as well as board operators, and how effective that management is in executing on their strategy and goals. So a lot of asset managers have looked at governance for a long time. So I think this is a very well-trod area in terms of how best practices have been developed and what asset managers are looking at to identify those different opportunities. When they look at this, they're essentially looking at board composition, the board election cycle, and how board members are compensated, as well as how that flows through to the rest of the company. I think one of the big risks in this area is generally if there's sort of a single founder owner who has control. One of these areas I think people look at is like Facebook in terms of Mark Zuckerberg having all the voting rights and control. There's really no way for, if shareholders were unhappy, for them to oust him from his role. So I think that's when they look at governance, I think Facebook actually gets dinged on that quite a bit, despite the strong financial results they've displayed. People may be uncomfortable with kind of that single person leadership having all the control of this giant entity. But those are kind of the broad pillars when we're talking about ESG and asset management. We'll now touch on kind of how that's applied by different asset managers and how to evaluate it kind of on an ongoing basis. But I'll pause there if there's any questions before we jump into this next piece. Great, don't see any questions. So when we're looking at ESG from the asset management perspective, I think, Callan, we've looked at it from a lot of different angles, and we think that this spectrum really represents kind of all the different ways that asset owners and asset managers can apply an ESG lens and strategy. So there's kind of a lot going on here, but I think the best way to read it is kind of left to right from the colored bars at the top. And the spectrum is essentially on the very far left side, you have just traditional investing in the spirit of, I guess, what we talked about with Milton Friedman, really just focusing on maximizing your economic returns without consideration of really any other factors, just making sure you get all the potential upside profits without thinking about other factors. And then all the way in the far right, you have philanthropy, which is essentially you're not worried about any sort of economic factors. You're just worried about a social outcome or improvement of a particular cause. And in between, we have a lot of different iterations of how to achieve, what different level, of ESG different investors are looking at. As you can see, the goals start with kind of a risk mitigation, and it moves all the way into kind of an alpha generation impact goal as you get further to the right. So from a risk mitigation perspective, what we're talking about here is limiting your exposure to a particular factor that you do not want to have in the portfolio. This is generally manifested through an exclusionary screen. I think this has been kind of the most popular area of ESG over the last 30, 40 years. Started, as mentioned, with apartheid. There was, excluding companies that did business in South Africa in the 70s and 80s. That's moved into, tobacco. A lot of portfolios exclude tobacco companies from their investments. Anything that people are generally interested in avoiding exposure to. This is also manifesting now in looking at how to minimize carbon in portfolios, a very topical area. So essentially companies and asset managers finding ways to tilt a portfolio to be less exposed to energy and large oil producing companies and more exposed to upside renewable energy companies, even if it's in an index fund, just kind of tweaking the weights of those. That's been a very popular area. And that's part of these partial integration as well. It's really looking at, maybe we don't want to totally exclude all the energy companies. We still want exposure. We have tracking error targets for our underlying investment portfolio. How can we look at that? So there's different strategies where asset managers will essentially pick kind of the best energy companies on an ESG basis and underweight the worst companies, but still have exposure to energy. So you're really kind of looking at the best in class of a particular industry and reweighting your holdings and price targets based on that, as opposed to just excluding a whole industry because they're involved with oil or gas. So those are kind of the risk mitigation types of approaches. As we move further right, we get into kind of just traditional fundamental asset management, where you're really looking to incorporate an ESG lens into the portfolio and help inform the decision making. This is also where we see a lot of strategies and a lot of asset managers employing. They are doing their research work, taking the universe of companies that they wish to invest in, going through their fundamental analysis, establishing which ones have the best upside potential, but then also incorporating an ESG lens and evaluating how that company treats its stakeholders, what their environmental record is, and the corporate governance at that company level. And that's not to say that they are not, other asset managers aren't doing it, but when we say incorporation, we mean that, and managers explicitly putting that as part of their process and saying, you know what, this, as part of my investment process, I want to incorporate ESG into our analysis. And here's the report on, what our ESG has done and how we think about it. So it's a very intentional use of ESG, whereas other strategies may be using it, but on the fringes or not articulating it as well. As you move even further right, we have sustainable and thematic strategies. This is taking it one step further, where the goal of the portfolio is to invest in a particular theme. It might be low carbon, it might be diversity or social awareness, or it might be like renewable energy, but really taking a thematic approach to the whole portfolio and anchoring that in the investment process and looking at companies that fit that particular theme or sustainable goal. Along the way, incorporating ESG, there's a stewardship angle where a lot of the portfolio managers are engaging with management board members to really push forward different initiatives that they feel will improve company operations or company disclosure of different matters. I think one of the biggest areas we've seen this is, as mentioned, BlackRock pushing on a lot of its companies to better disclose pay and diversity statistics, but other asset managers asking about more carbon disclosure and how they're measuring their carbon output and making sure their companies are at, conducting best practices as to how to measure and manage that. The last bucket we have here is impact. This gets into more kind of the private side and private equity and private credit and definitely infrastructure. But the goal with impact is to have an investment that has a positive social benefit, but also provides some sort of economic return as well. And perhaps those goals are kind of 50-50. We see a lot of this in terms of community building, in terms of be it a real estate deal that essentially is using the real estate site for be it a homeless shelter or a community bank or something that is directly impacting that community, but also someone is making an economic return from that. So it's a much smaller subset of strategies and it's very targeted, but that is an area we've seen a lot of growth on the private asset side. But these are essentially kind of the different flavors of strategies. And we actually have examples here in the book. I don't need to run through every particular one over the next few slides, but if you jump to slide 13, Hannah, this is kind of a summary of, so we have all these strategies, ESG is out there, but why are different types of plans actually integrating ESG into their process? So we've outlined here kind of, I guess, broadly the different plan types and pools of assets and why they've seen an uptick in interest for ESG going forward. Generally for pension plans and different defined benefit plans, it's been concern regarding potential headline and reputational risks. Over the last 5 years, we've seen a lot of funds asking us to help measure their exposure to different firearms manufacturers, as well as other controversial entities. We've seen it with, aligning the time horizon of the liabilities within a plan, along with what people view as risk in terms of climate change or global warming or whatever that long-term horizon might be. And how do they think about that from building out, kind of their asset liability modeling and what the potential returns might be, and how do we project those returns going forward? Finally, there's other areas, particularly the state of Illinois. They have actually enacted laws that require all state funds and plans to formally evaluate ESG for any of their asset managers. So they developed a particular questionnaire and documentation that asset managers and their staff have to do in the process of procurement and looking at hiring different asset managers. So I think we're seeing a lot more uptake in interest on the defined benefit side from those sources, but it's across different asset pools. I mean, I think one of the interesting ones is insurance. A lot of insurance companies and their pooled assets are actually looking at how to price out the potential cost of, changing climate and increased risk of disasters. We've certainly seen this, unfortunately, in California with the fires, but also in Florida with hurricanes. So really looking at how to price that appropriately and ensure that they're able to cover both the claims as well as generate the appropriate returns to be able to cover that cost. But it really depends on the type of plan as to the specific goals, which we think is very interesting. Where an area of interest that Callan has seen a lot outside of our defined benefit plans are actually in the defined contribution side, where we see a lot of retirement plan sponsors asking, due to interest from participants in their plan who are younger in the workforce or just entering the workforce, call it millennials or Gen Z, asking, what type of options do we have as we're, want to align our goals as individuals with, what the company is doing, as well as I want to put my money to work in causes I believe in. So we've done a lot of work on that. The other interesting side of that is where we have added a particular fund to a defined contribution plan. We haven't seen a lot of assets map over from other participants. So the fund is in the lineup, but we just haven't seen a ton of uptake from participants over time. That might be changing, but I think that's something interesting that we've observed as we've done a lot of work in the space. So if you go to the next slide, Hannah, how does Callan take all this ESG and put it into action for our clients, and how are we looking at it? I think we really have these kind of broad, three-circle broad approach here. The first step is just the design. So the research and education, really defining what a plan's goals are, documenting that, and making sure that staff and trustees are well educated and know exactly what they want to do and what their goals are for the overall plan as they think about ESG. The next step is kind of the implementation goal. How do we identify areas of the portfolio where this might be implemented, or different plan documents where this might be incorporated and properly documented? And how do we find the most appropriate solution for the custom goals of each client? I think that's where Callan comes in. We really want to work with our clients on ESG to understand what their shared values and goals are and how they want to express that in the plan. And to clients who have implemented, the third step is monitoring, really understanding what exposure these managers are giving you and making sure that it's consistent with the message we've received from them over time, and developing a process for how we measure success. Is it engagements? Is it ESG reporting? Is it minimizing carbon? What are the metrics and KPIs that we're looking at the plan level that we match up with the asset managers to make sure that that ESG implementation is occurring in the way that we would expect. If you jump to the last slide, Hannah, this is just kind of the implementation roadmap. We're in the top left corner, just starting with a board and trustee education and really understanding, what the universe of ESG is from a high level and how it kind of, then frames into what you can do at kind of the plan level. I think for plans of, your size and what you folks can do from an ESG perspective, it's really just think about, what the goals would potentially be and what the shared values of the plan would be. And then, the next step for all plans is once they have, kind of decided what they could potentially do or what kind of view they want to express, documentation, the investment policy, or developing a statement of investment beliefs is kind of the next step to think about if ESG is of interest or consideration. And then, there's all these other steps of figuring out where, in an asset class implementation, if there's a manager search, and then figuring out exactly how to implement that over time. But these are, kind of a long time horizon process. We certainly don't rush any of these things. So I think that is kind of the summary of ESG from a high level. If we jump to the next few slides, we've included excerpts from our ESG survey. There's a lot of data and information here. I think one of the interesting ones to jump to is actually, we jump to slide 17 here. This just breaks out who the respondents are to this particular survey. So as you can see, about half the respondents were, public plans, with 41% being actually defined benefit. And then on the bottom here, just breaking it out by size, majority of the respondents, about 60%, were anywhere between, 3 billion and under in assets under management. So pretty broad group of respondents to this survey. I think if you jump to slide 20, Hannah, this outlines essentially over time what types of plans have actually implemented ESG and where you're seeing kind of increases. As you can see, public plans, only 36% of respondents have done any sort of incorporation in the past year. If you look at the data, 2019, that was up to 50%, but then back down to 36. So I think that was more of the kind of the sampling of the survey as opposed to a trend line, because the consistent trend line has been an increase, but a slow increase. You can see in 2014, only 22% of respondents had any sort of implementation, up to 36 in 2020. So that's something we kind of continue to watch. If you jump to the next slide, this is actually by size. You can see that it's actually, for smaller plans, more difficult to implement. Any plans under 500 million, and we see that pretty consistently across the board. It's an area where, as Greg mentioned, being in funds makes it difficult to really express kind of a custom view. You're sort of beholden to what asset managers are doing. And we found that pretty consistent for plan sizes under 500 million. We are seeing an increase across the board, but as you can see, the area where we see the most uptake over the past few years has generally been kind of the mega plans. Anything over 20 billion, anything 3 billion to 20 billion is also seen a pretty substantial increase. Finally, I think two more slides. If you look at slide 23, so how are people actually integrating ESG when they do? I think interestingly, it's manager selection versus the investment decision-making process. On manager selection, it's really, communicating to investment managers that ESG is important to the fund. So really just engaging with the asset managers and really finding out, how they're integrating and how they're doing that over time. How are actually people doing it from an investment decision-making process? They're adding language to the investment policy statement and pursuing education or adding investment beliefs. So I think that's kind of the majority of area that we've seen people integrate and kind of put ESG into action within their plan. And I think that's the trend that's going to continue. I think the final slide that's most interesting is why plans are not incorporating ESG, which I think is on slide 30. If you jump to that, Hannah. So equally, we ask, if it could be sort of a selection bias here where you're asking all these plan sponsors who have integrated ESG, so they're all kind of gung-ho. So when we ask, we also want to know the plan sponsors who say no, why haven't you integrated ESG? And so these are the responses from those who have not incorporated. As you can see, majority of the responses, essentially, 39%, the benefits of ESG incorporation are kind of unproven or unclear. Really what's in it for me, and, is it worth kind of the resources dedicated to it for the outcome we're seeking? So that's the majority response we've heard, and pretty consistent with a lot of different clients. Really just trying to understand if dedicating the time and energy to it is going to match the output that they're seeking. The other big response is that a lot of sponsors are considering it, but they haven't taken any firm action. So it's, on folks' radar, they just haven't figured out what the first steps or next steps, or they have higher priorities. So I think that's something that we're also cognizant of. And finally, I think that third one in the middle of the page, 30%, not considering factors that are financial or related to investment decision-making. We've seen this decline over time. I think folks are understanding that ESG is best viewed kind of from a risk lens, as opposed to, is this going to generate incremental alpha? It might, but it's like any investment, past returns don't indicate future results. I touched on this. I want to touch on this one because I think we've seen a lot of confusion out in the ESG landscape, particularly as different political regimes come and go. The Obama administration had initiated different rules as it related to ESG in defined contribution plans through the Department of Labor and the SEC, making it more permissive. The Trump administration came in and actually reversed some of those rules and came out with their own rule in the Department of Labor about a year ago that was more restrictive as to what defined contribution plans could consider. And then the Biden administration came in this year and said, essentially, ignore that last rule. We're now writing a brand new rule that's coming out later this year. So there's been a ton of back and forth. It kind of goes with the political trade winds. And I think that's caused a lot of confusion on sort of the fiduciary side of things. And while the DOL regulations don't apply, directly to a pension plan, I think it does provide a lot of guidance as to how the DOL, the SEC, and all these other regulatory oversight agencies are looking at ESG and, kind of the interest of plan sponsors, both on kind of the defined benefit as well as the defined contribution side. So there's gonna be more to come later this year. They haven't published the rule yet, or the proposed rule. Then there's a comment period, and then the final rule will probably be, I think the goal is by year end. So we'll see how long the comment period is and what kind of feedback is received. But generally, that's kind of the friction we've seen with ESG and adoption is just, there hasn't been a ton of oversight and regulatory guidance from the top. And when there has, it's then been flip-flopping between administrations. So it's been hard for folks to really say, okay, I want to invest the time and effort if, it's kind of a shifting sands that they're standing on. Those are kind of my prepared comments. I'll pause there if there's any kind of questions for clarification or anything else.
Director Anderson.
Yeah, Mark, thanks for the presentation. It was very helpful. And I just want to kind of ask a question from Callan's perspective, because you brought up the uncertainties right now with how you measure this and what its value is. There were also some slides there about the growth in Gen Y and millennials in their purchasing power, in their positions as executives and so forth. And I've been reading some lately that this concept of ESG is almost going to become endemic as we have a couple of generations with new perspectives. Is essentially the most successful businesses are going to be ESG businesses, and it'll kind of be evident as you go to make your investment decisions, because they'll be the best performers as well. Is that ascribed to that thinking?
I think, Callan, we're certainly not at the forefront of, pushing out kind of our thoughts on ESG particularly, but I think you're right in the sense that it becomes endemic as more information becomes available. Right now, I think where the potential upside opportunity is, at least in public equity and some fixed income areas, is finding kind of a unique piece of information that's not broadly applied across every company, and using that to your advantage to come to a better analysis of that company. So in the past, that might have been figuring out the carbon emissions and determining their impact on the environment. I think today it's really looking at kind of some of the workforce composition and perceptions of companies, and how do you quantitatively measure that and figure out how that impacts the price target. So I do agree that long term, these will become kind of regular factors that are considered alongside kind of the typical financial statements that are published. I don't know what the common framework is. I think that's one of the big frustrations with ESG, is there is no common framework of what factors are supposed to be reported. And you see that with a lot of the different ratings agencies. MSCI has their own ratings, S&P has their own ratings, and a few others, and they don't all agree on how to evaluate a company. So until there is kind of this broad agreement of, what specific factors are to be reported and measured in a certain way, I think you will have these different opinions on what's a good ESG company and what's a bad ESG company. But long term, these will become, kind of endemic, as you say, and factors that we just consider alongside, the price earnings ratio or the bottom line profits that companies are generating.
Director Shoemaker.
I think you're on mute.
Okay. Let me try that again. I have a bunch of questions, a couple comments. I won't give them all. I'll step back after a couple and then dive in after others. But if you were to look at like the top 3 performing ESGs in the market right now that could be considered by the defined benefit program, how would that go? How would their performance compare to the market in general or top performers in the general market?
Well, I think you raise an interesting point that we were discussing actually before the call. Right now, it's an interesting period because there's been a lot of funds that have been created, and funds over the last 5 years that have a real ESG overlay have tended to be overweight technology and underweight energy. And so those funds have generally performed very well because technologies outperform pretty precipitously, as we've seen, and energy is underperformed. But I think what we think about at Callan is, is that because of ESG or is that because of those inherent sort of industry bets underlying ESG? And so that's something we don't have a good answer to. So I think to answer your question, I think the ESG funds on a performance basis look pretty good over that period of time, but I don't think it's because of, I don't think you can directly attribute it to ESG factors. As a byproduct, do technology companies emit less carbon? They generally do because they, operation, the most carbon they're generating is from like a giant server farm or, some of those operations. But that doesn't necessarily mean that'll last forever in terms of that ESG score. So, that's an area where we have a tough time attributing performance to specific ESG factors. Is it the case that long term, if you are under, you don't emit a lot of carbon, you're going to outperform in the market? I mean, that's up to kind of the market participants and the perception. But that's not a call we're going to make at Callan. We still think there's, a lot of value in having exposure to these different industries because you don't know which ones are going to do well at which point in time. So I would say, to answer your question, ESG funds have looked good relative to other funds in the market, but I can't attribute that specifically to their ESG-ness or their ESG factors specifically.
And that could be categorized by Biden's election and the uptick in solar and wind and that kind of power stuff, right? Something like that.
I would say less the uptick in particularly like solar and more like just these ESG funds are really just invested in big tech companies. Like Apple's a big holding, Zoom, stuff like that, where it's, not directly related to ESG so much as it's like they don't emit carbon, so let's invest in that. And then if you look at ExxonMobil, not having exposure to ExxonMobil, I think it's been cut in half from a market cap perspective over the last 2 years and probably down, I think 70% since 2013. So, looking at a company like that went from the largest company in the index to now, maybe not even the top 50, if you just didn't have exposure to that, your performance kind of goes up. Why did Exxon go down? I don't know if it's so much a decline in consumption of fossil fuels so much as it's production from fracking and other sources creating kind of this oversupply. So these large vertically integrated oil companies, just aren't as nimble, but there's been so much supply that, these giant oil rigs they have in the middle of the North Sea don't make as much sense economically. And I think that's what the market's reading into it.
All right, so observation, we're actually in the 500 to 3 billion category in your charts. And I'll sit back for a minute.
Director Harrison, you were one of the people who requested the presentation. Any thoughts? You're muted.
Question to Callan. Do we do anything with voting our proxies? Do we exert any pressure in that direction? Is this just something that we have not made a priority, or is Callan too small? Are we too small? I know that institutional investors, particularly the large ones, have been integrating ESG for quite a long time. And Richard, to your comment, it seems to me with the change in administration in the US and what is finally amongst many people, the dawning of what climate change is bringing about, it seems that the time for continuing to ignore ESG factors or to minimize them is, if not past, certainly passing. And I remember bringing this up years ago. I've only been on the board 6 years, but it was relatively recent, but about our incorporation of ESG principles, or even to discuss them, and it was shut down. So I think my question is, can we continue to shut them down or to ignore them, or should it be something that we as a board should be discussing in the future, possibly at an offsite? So Mark, there's a number of questions there, but are we doing anything other than having a survey with Callan? Hello?
Yeah, Jerry, I appreciate your question. As we think about, kind of the construction of the plan, you're invested in funds. The funds themselves are voting the proxies. They tend to use different services like ISS to help them manage all the thousands of proxies that come from all the underlying, hundreds of companies that are invested in the plan. So I'd say as of right now, no, I don't think the plan is exerting any sort of proxy influence. As to how you can direct your proxy votes, I would have to look into that specifically for the funds. But right now, I think the survey is happening. What else other plans are doing is figuring out different ways they could potentially measure their exposure to different factors that typically manifests in carbon as being one of the easier things to measure within a plan. It's really understanding at the total plan level, all the companies that we own, how much carbon are we emitting versus what's in the benchmark, understanding those factors. I think coming soon as more data is released, will be kind of like a workforce assessment of, what's the composition of the underlying company's workforces and how does that compare to kind of the benchmark or what our targets are. So I think that's really directionally where plans are going, is getting in and measuring a lot of these different factors. As you mentioned, potentially voting proxies or having a view on how to vote different proxies. But I think that all starts with figuring out what the plan, the shared values are of the plan, what direction do we want to vote proxies, coming to an agreement on that, and then writing that into the investment policy or an investment belief statement to articulate it and make it publicly known.
Okay, good. I know CalSTRS didn't, that we divested from tobacco. And it was a real, it caused a lot of consternation. You know, as educators, we certainly didn't want to promote smoking. But in one short, maybe 2-year period of time, we also lost $1 billion because we were not in tobacco. And so these become really fundamental board questions as far as what we believe as a board and how we can make our thinking and our set of principles reflected in what we do and where we're putting the finances of the employees of Mendocino County. So I just don't think it should be something that we sort of put on the shelf and pick up again in 3 or 4 or 5 years. But maybe it behooves us to have a fundamental discussion about what we can do about climate change, and are we just too small to influence anything? I know county employees are certainly intelligent individuals, and I'm sure they have some very core thinking that would dovetail with things like being sure our boards and our companies are diverse, that there's a good percentage of females, that we're being sure that we have minority leadership, not just white male leadership. Thank you, Claire, by the way, and also you, Greg, for 31% for a year. That's incredible. But do we have a lot of players out there, and are we trying to hire people who are more diverse? These things are core values as far as I'm concerned. And since I've been on the board, I don't know how much discussion we've had about them. Sorry.
Well, Jerry, I I appreciate your comments, and I think this is timely for this discussion. So want to go to Director Chatmeyer?
So I know that we don't have any mutual funds that are exclusively ESG, and I don't even know what's out there in that respect. One of the things I just want to tell you a little bit about what happened with me back as county treasurer in 2013 was I had a group of Occupy Ukiah members that were looking at all the investments of the treasury pool, which is county schools money, county's money, and special districts money. And I can't remember exactly how much was in it at the time. Now there's, you know, probably in the neighborhood of 300 to 350 million that's in the treasury pool alone. So one of the things that came out at that time was they were really concerned. I was very transparent. I posted the holdings on our website. I've always done that ever since I could do that, which has been about the last 9 years, where we had an investment advisor that really helps us a lot with that. But they could see we were in individual stocks. We weren't in any mutual funds. We were in individual stocks. So they could clearly see what we were in, what names we were in. So they came to me and basically said, hey, we want you out of Coke. We want you out of Walmart. We want you out of Pepsi. We want you out of all these things. And basically one of the things through that process, and the Board of Supervisors had a real interest at that time. I don't know if this was prior to Dan Jurdy or not. It might've been right when he was coming in. They had a real interest in it as well. And so one of the things that we did at that time was our investment advisors, along with them, I worked with them, and we looked at the Calvert Social Index. And of course that looks at, I'm sure Mark's familiar with that. I'm sure, yeah. And so anyway, but they look at all the stuff that is being talked about in ESGs, all the, you know, how you do the workplace, are the products safe, how you are in diversity, all that stuff. They look at all that, and these are just American companies, and they're like the top 1,000 companies or something like that. But what I was pleasantly surprised about was that our investment pool was socially responsible, because even some of the ones that they wanted us to get rid of, you know, I was able to come back and say, hey, they're they made the list. They were approved by Calvert Social Index. And so I was able to say, hey, you know, we are truly socially responsible. We had at that time maybe 75 to 80% of our corporates that were on the list. Anything outside of the United States was not on the list. So that you couldn't look at those. The other thing is some of the bigger places like I think it was Berkshire Hathaway, also I think even Costco, some of those, they don't necessarily participate in doing that. They're, I guess maybe they just, you know, that's not something they want to do. But my point to all that is that it's possible that because we are in so many mutual funds, and Mark mentioned Apple, that we are in socially responsible, you know, like we have our money invested in corporations that are socially responsible. We're just so diversified that nobody's able to go, hey, you're in this, you're in that, you're in that. And you go back to the tobacco, you know, it's just, so anyway, that was my experience. And I do think that it's possible that because we are so diversified, we may be pleasantly surprised that we are conscious of some of this ESG, some of the benefits of that. Thank you.
Good. Thanks, Sherry.
Robert?
Yeah, trustees. Mark kind of alluded to this in response to Trustee Shoemaker's question, but one of the issues that's currently kind of a problem for measurement of ESG is just the general lack of consistency of what each factor can mean and how to measure them. Going forward, it's likely that those uncertainties are going to be clarified, whether that's, you know, through administrations or even the SEC. But I guess the hope would be in the future there would be more clarity, and that would allow the board to kind of make better decisions about ESG. In terms of our specific publicly traded managers, we do have 4 out of the 9 that are qualified or rated as low carbon by the Morningstar ESG rating index. We also have our infrastructure managers are also keenly aware of some of these ESG factors. IFM specifically with solar and wind farms. And so we do have some slight exposure towards ESG related investments. There certainly could be, you know, questions again about what does that really mean and how is it measurable. But unfortunately, in the whole industry at this point, there's not a lot of clarity on what that means. You know, Mark alluded to that in his response to Trustee Shoemaker's answer of, you know, how are the best ESG funds doing? So I kind of just wanted to mention that so the board is aware of it. So the board members are aware of that.
Thanks, Robert. Director Anderson?
I was muted. I appreciate Mark and Robert's comments because I do think that there's a lot of there's a lack of clarity out there right now. Hope it's growing. As I mentioned earlier, I think that as you see a new generation come into executive positions, come into actually the wherewithal to have wealth and to direct that wealth to where it's going. You'll see it go to more responsible companies. But somewhere in the presentation, they discussed a little bit the headline risk. And I'm just thinking like in this last year where Amazon, for example, was lauded for its support of the Black Lives Matter movement. And then a few months later, they've got problems with union busting accusations down in the South in predominantly Black distribution centers. You've got companies like Lockheed that are ESG certified companies by some of these standards. And so right now, with that lack of clarity, one, it's hard to determine whether or not it's truly an ESG company when you kind of dig into it. And two, there is kind of that headline risk. I know we're early and we're just having a conversation, but I think this is one where, as fiduciaries, understanding it, but allowing that clarity to evolve and moving slowly is probably a good idea.
So I'd like to ask a question. Jerry brought it up about that sometimes there are, my understanding, there are associations that you could join in and have them vote on our behalf as stockholders in these companies. And I'd like to know if that is an option for our mutual funds. But secondarily, I see, the carbon emissions as a real risk. Who would have thought 10 years ago that PG&E, one of the largest, I think it's the largest privately owned utility in the world or in America, would be successfully, sued or they settled for starting fires for lack of maintenance of their distribution lines. Is it really that far-fetched to think that the oil companies won't be sued and maybe go out of business 10, 20, 30 years from now due to their role in climate change? And what's the risk to a portfolio that owns oil companies like Exxon or Chevron? So I don't know. I just think there's a risk there to the fund to be exposed to companies like that. Want to go to Doris?
Thank you, Chair Jurdy. I just wanted to follow up on a comment that Mr. Wood made, and then also in relationship to Jerry's comments. In the board's investment policy, they have a section on investment beliefs. The last time it was updated was in May of 20. It's scheduled for review every 3 years, but if the board was interested in reviewing the investment beliefs and the investment policy statement as a whole, that might be something that we could incorporate into the strategic planning meeting or a future meeting at your board direction. I just wanted to throw that out there.
Thank you.
Okay, want to go to Jeff and then Director Shoemaker.
Thanks. I wanted to mention two things. One is I'm very sorry, but I have an 11 o'clock meeting that I'm going to have to go to. If any issues come up, Doris or Judy can get a hold of me. As far as this discussion goes, you're absolutely all on the right track, and you haven't necessarily talked about our fiduciary duty to the plan and et cetera. But having these kinds of discussions and these agenda items are absolutely consistent with your fiduciary obligations. And these are the good kinds of discussions, because when it comes down to fiduciary duty, it's really all about the process and learning and training and making decisions, or the process that leads up to those decisions that are being made. And I know this is just kind of more of a study session, and I don't know that you're taking any action today, but as you move forward and having these discussions, obviously you want to be acting in a manner that's consistent with your expert advisor, in this case, Callan. And so, if and when the decision time comes to invest or change the investments, so long as you're acting consistent with Callan's advice, ESG could be absolutely appropriate. And just having these discussions, again, are consistent with your fiduciary obligations. So I just wanted to mention that.
Okay, thanks. Director Shoemaker. You're muted.
One of these days we'll get that one right. So I just was thanking Mark for this presentation. It was a great educational experience. I'm on another board that has, for the last 6 months, wrestled with this question, did some small allocations, and it's not seen them perform as well as we thought they might. But specifically to what we've heard, it's really interesting. There's positions of advocacy or avoidance, such as carbon reduction or guns. And those are pretty interesting conversations to have that with our size, pretty tough to have. I think in the forward, I think we should discuss this at our strategic planning session and what Dora suggested. Robert's comments were great because it was something I was thinking about is how do we rate our managers in these categories? And if, we haven't put restrictions on our managers around ESG, but if we're using folks that their own organization is under the, ESG governments, or they're going over low carbon things, that's good for us to know, because to go straight into looking at each individual company would be really tough. I think later on our agenda, our chair wants us to talk about things at the SACRS conference. This is a great one, including a SACRS survey of how everybody might be looking at ESGs in the future. So I guess in the short term, for us kind of looking at our fund managers and talking about changing our statement is to me a conservative path forward, but a good one. Thank you.
Looking to both Doris and Callan, what would you see as next steps for the board?
Chair Jurdy, if the board is interested in pursuing this further, I would suggest that the board reconsider the investment belief statement that's part of our investment policy and look at the first steps of incorporating certain things there. We can also then, in response to Trustee Shoemaker's and Robert's comments, look at what information can we get from our current investments as far as the ESG components of the companies that they hold, to see if we already have or how much exposure we may already have to companies that are working in that space. As Sherry said, many of the things that the county was owning in their treasury pool turned out to be on that list of environmentally, socially, governance listing from that agency. So we could look at items like that, and I would suggest that maybe we add that to the strategic plan meeting if that is board direction to do so.
Okay, if we could take a survey, would board members like to see that discussion incorporated into our strategic planning session?
Well, obviously I would.
Okay, so it looks like it's board direction to incorporate that into our planning session. Okay, great. Well, thank you, Callan, for your multiple presentations. Is there anything else you wanted to add today?
I don't think so. Thanks all very much for the discussion and attention to the subject and to all the reports. So we look forward to continuing these conversations, and of course we're glad to support the board conversations in the future as well.
Before we lose Callan, we may want to see if there's any public comment.
Okay, great, thank you. Do we have any public comment on this agenda item?
There's no public comment at this time.
Okay, Director Shoemaker.
Richard, you're still muted.
If I just move my lips, without saying anything, it'll be the same. I was just going to suggest, if possible, to get more detailed information from Callan about their clients' movement toward this kind of activity. Thank you.
Okay, all right. Well, it is 10:50. Jeff has to go for another meeting. What if we took a short break, then went into quarterly budget update and the last couple items? So it's 10:50, come back at 11 a.m.
Thank you. Yeah, perfect.
Thanks all. Nice to see you.
is the quarterly budget update.
Thank you, Chair Jurdy, members of the board. Attached is the fourth fiscal year quarter update for last year's budget. The final numbers, we come in about $268,000 less than budgeted. Our actual was at 1.239, and there's a narrative section that talks about which sections were over or under projected budget amounts. If you have any questions regarding this, Robert would be happy to address any specific questions regarding any portion of our budget items.
So Robert, I mean, sort of like the headline there that Doris went through is that it's about 18% under budget. Do you want to just kind of go through the highlights as to why it's substantially under budget?
Yeah, board members, you do have the you do have the budget update in front of you. I'm adjusting my screen here. I'm gonna jump to the final schedule, which is Schedule 2B. That's the year-to-date schedule that shows our budget versus actuals for the entire year. And so I'll just start at the top and kind of work my way down. The largest savings in the administrative subsection is coming from legal expense. That was tough to estimate. You know, it was very difficult to kind of estimate where that was going to land. But luckily it was fairly under budget. As I mentioned in the notes, there was savings in 2 of the individual vendors that we use, and only one of them went over our budgeted amounts. So that was a large savings. The consulting actuary line item sort of jumps out for the opposite reason, in that it was over budget. And the primary reason for that was because the risk report was not included in the budget. The next item that kind of jumps out would be staff education and training. There was significant trainings, I guess, but a lot of everything this year was actually virtual. So the cost of everything is much lower. And that's the primary reason for the savings. Of course, the budget included travel expenses, hotel fees, travel, and none of those expenses actually precipitated. The personnel line item, I guess, is the final large savings. That like I alluded to in the memo, there's a bit of a timing difference between the periods in the first quarter and the periods in the final quarter. The periods in the first quarter tend to be have the expenses overstated in the budget, while the expenses in the final quarter tend to be understated. And that's actually reflective in Schedule 2A. So you can go back to 2A and look at the personnel, and you can see that for the quarter, personnel was above the budget. But that's just kind of a quirk of the budgeting procedure. Going down into board expense, the primary savings there is board education and training. Really the same factors are influencing board education and training that's influencing the staff education and training. There's a large budget for travel, hotels, meals, and some training expenses, registration fees. And that budget also includes the board retreat, which wasn't able to happen. So that's part of the reason why that number is so large. The fiduciary line item also went above budget about 22% almost, and that was general trends in the industry primarily, the increase there. Disability came in well under. We're probably fortunate that that happened. Again, that is kind of difficult to estimate, and the budget has essentially stayed the same for a number of years. So that $120,000 for the disability hasn't changed in quite some time. Moving down to technology. Technology overall is very close to budget. It's just under, barely. But the individual line items for LRS did go over the budget, even with our budget amendment in October. It wasn't a whole lot over, but it did squeak over a little bit, about 1.4%. And that is primarily due to programming changes that have really ramped up in the fourth quarter of the year. There's quite a large jump compared to our normal expenses. So you can also see that if you look at the previous schedule, Schedule 2A, you'll see that for the quarter, the pension gold expense was about 173% above budget. The county IT has fortunately stabilized. We weren't 100% sure if that would or wouldn't. And so when we did the budget amendment in October, that amendment included a fair cushion for what we thought might happen based on current experience at that time. That number has definitely settled down to, just slightly over our historical norm. Moving on to the investment subsection, the large savings there were in investment monitoring, which we didn't use, as I mentioned in the memo. That money was primarily used for on-site due diligence. And with the COVID lockdowns, that was not able to happen. And it appears also unlikely that that's going to be happening going forward. So we're kind of expecting that again in fiscal year 22, based on recent COVID lockdowns and activity. The investment manager fees are under budget overall. Part of that reason was because we took some money from the managers that we do pay, 91 and T row, and we funneled that towards our fixed income managers. Of course, that line item itself is based on the net asset values of T row, Mondrian, and 91, and so lowering the asset values of two of those managers saved us a little bit of money, even though we've had relatively high good returns and higher net asset values kind of than we assumed. In the future, that line item is going to include expenses, manager fees for JP Morgan. So that will be an update that you'll see in the final that you don't see here. And so that number is going to be greater than the budget. That previous year budget did not include the estimated fees for the infrastructure allocation. We weren't 100% sure when that was going to be called. At this point, we are expecting to have IFM call the funds after the December quarter. So it's likely that that we'll have more fees in that particular line item related to IFM by the end of fiscal year 22, just to kind of give board members a heads up on that. And the property maintenance plan, that's those are for capital expenses. We really haven't had the need for that. 2017, 2018 was the last time that those funds were spent. And the property's in pretty good shape right now. Speaking about the building, we're also waiting for our real estate appraisal for the building. So we hope to get that in a few weeks. And that'll allow us to update the cost basis on the building for our investment reports. So that's another change that we're waiting for, and of course the board will be notified once we get the results, and you'll also be able to see the results in the monthly financial reports as well. So we'll make sure to let you know. Overall, expenses were down about 11.5%. So those are the basic highlights.
Director Anderson.
Thank you. And thank you, Robert, for both your written and verbal report. They're very good. This may be more of a question for Doris. With the savings in the disability line item, just a quick question. I know staff's been really busy. Are we having a backlog, or are there just fewer disabilities?
We're continuing to process applications. The rate of applications has been slower. I do believe we have a couple in the queue that are being worked. The board has seen over the past year a couple come to you for determinations, and subsequent to that, should someone file for hearing, we would proceed with scheduling that. We don't have anything that we're holding because we're doing project work. We're continuing to move forward with everything that's regular operations.
Great, thank you.
I think overall the county is probably seeing fewer people in some form of disability for extended periods of time than they were several years ago. I think the risk function and the departments, I think, have been a little more on top of getting back to employees who are on a workers' comp claim and saying, hey, come back into work and we'll find something for you to do. And my understanding is that when people are left at home wondering if the employer doesn't really want them, that they're a little more active in saying, well, gee, maybe I should file for a disability retirement. I guess the employer doesn't want me there. So I think there's been some reforms at the county in the last several years that have reduced the total number of claims running through the system. Okay, if there are no other questions or comments, I think we could go on to the next agenda item, which is the administrative report. I want to clarify, did we have any comments from the public on that agenda item?
I have no public comment at this time.
Okay, thanks.
Thank you, Chair Jurdy. The administrative report is in your packet. I wanted to brief the board on a couple of updates we're in the middle of our testing right now with the release of the new environment for our pension administration system. It's been released to our test environment. We anticipate a move to production late August or early September. That's in progress now. That was something that had been sort of postponed due to COVID and the project work and other things, but it got to a point that we needed to move on that. That was scheduled and is well underway now. We also have, as part of our routine annual time of year, the valuation going on currently and our annual financial audit. Both of those are well underway, with information having been provided to the actuary and confirmations having been sent for the audit. Pardon me. I'm using two computers and the mouse doesn't only work one of them. So there is a reminder that the SACR's request for content for the upcoming conference deadline is approaching at the end of the month. So again, in your materials from last month was SACR's comment and survey form. Please provide that information to the SACR's program committee, because they want to make sure that they can put together a conference that meets the needs and interests of their members. Also attached to the administrative report was a legislative update that talked about some current legislation that could impact the system, specifically Assembly Bill 826, that was really in response to Ventura's county's concerns about the Alameda decision, and is really addressing their issues with implementation of Alameda. The other item on the administrative report was a discussion regarding the strategic planning meeting. At the last meeting, the board asked for a survey to determine date availability for potentially meeting in person and doing a comprehensive offsite strategic planning session. And a survey was sent, the results of which were attached to the administrative report. Due to increased COVID activity because of the Delta variant, I did add a question asking whether the board would want to postpone, go ahead and meet in person with COVID prevention protocols in place, or hold the strategic planning meeting virtually. The majority of the board's first preference was to postpone that until they could do a live meeting absent the COVID restrictions. There were also several questions about preference of format, and I can run through that, or any questions you have. If the board is wishing to postpone, the direction I would really want to know is, when would you want to potentially come back and discuss a date in the future again? Do you want me to bring it back in 3 months and we can see how the COVID outlook occurs? Then there were some dates provided in the survey, but all of those were September, October. I don't really expect the current restrictions to change significantly before those dates are up. So I really need the board's preference and direction on how you'd like to proceed.
Director Smith?
My question, Doris, would be what you think the needs are. If we have a strategic plan with the goals and vision and statements that we need to continue going, and you've got this huge project you're working on, if it gets delayed 3 or 4 months, I'm fine with that. But if we are needing to make decisions, some changes as to how things are worded, and especially given the ESG discussion today, but also just in the goals that we set several years ago, if we need to make changes in those, and you think that we need to have a strategic planning meeting before then I would change my vote to I'm willing to do it by Zoom in a day, if that's what you think is needed.
I do think there should be board discussion about the specific goals and how those goals are phrased and or measured. That being said, it probably could wait a few more months, and we could have that discussion later when we meet together. alternately, I'm happy to attempt to provide something via Zoom, but I think the Zoom meetings can make it more difficult for engagement. And I would be concerned about trying to do a robust strategic plan remotely. That's not saying we can't do it and we won't do it, but I really just want the board's preferences, direction there. I do believe we need to revisit what the objectives are and how we want to approach those in trying to meet those objectives, and how we measure whether or not we're successful in meeting those objectives.
Well, I would think that, given the timing and fall starting and holidays coming up, that if we don't do anything in the next month, then we probably are going to have to wait until after the holidays. That's my guess.
I also wanted to potentially look at maybe changing on a regular basis when the strategic plan is done each year. It seems to be done in the fall, probably to start with a new calendar year, and maybe we want to move that to being done in the spring and doing it on a fiscal year basis, simply to maybe move it out of fire season, because I know there were concerns about trying to do a strategic planning offsite meeting when we're dealing with drought and fire and everything else that's going on right now, and that seems typical of this time of year that we're in.
I would like to postpone it if we can. Those dates that are suggested are extremely difficult for me to attend with my day job obligations and upcoming deadlines. So I would prefer if we could move it out till January or later in the spring, like you suggested.
Something else to be thinking about, that the COVID surge that's going on right now is pretty big. It's impacting the hospitals, and I've heard that there's some belief that the vaccines that we received will probably need a booster in about 8 months. So everybody could be thinking about when they got their initial vaccines, and that might put most people around November, December in terms of when a booster shot, they might be getting a booster shot. So if we did have it in January, February, that might be a good time in terms of our vaccination status.
But if through the chair, I'd just like to add too that as a newest board member, and I can't even imagine how Doris feels as the executive director, it would be nice to sit down with you all face to face. And I don't think online there's a really good is a good substitute for that. The other thing that I'm thinking of as far as the timing of the planning is, in addition to fire season and all of that, it's when your actuarial reports coming due, it's when your audits being completed and so forth. There's a lot of unique business functions that happen in the early fall. So I think a spring, if that provides Doris with enough direction, that the spring would be best.
I think that would be doable. Hopefully we'll be past the worst of the COVID for sure by then. It would be nice if it ended. So I'm happy to look at bringing this back at the first part of the new calendar year, if that's the overall board direction.
So I'll chime in on January date. All good.
I'd like January as well, January, February.
Okay, Director Shatmeyer.
I'm good anytime after the first of the year.
Wonder why.
I'm in agreement with that.
Okay, thanks. Director Anderson. Your electronic hand is up. Okay, right. So it sounds like the target time frame is about January, February.
Thank you. That concludes the administrative report, unless you have questions regarding anything else on it.
Okay, do we have any public comment on this agenda item?
There's no public comment at this time?
Okay, great. Well, then that takes us to the Sackers report.
Okay, I didn't realize there was a Sackers report. I'm not seeing that on my agenda.
The Sackers item was just the legislative update that's attached to the administrative report, or it was referenced in there. It was just a separate attachment.
Okay.
So there really isn't anything separate there.
Okay, great. Well, then, do we have any general board member items?
I would just like to say that I really enjoyed the Berkeley presentation workshop this year. It was very interesting, and we were allowed or had the opportunity to download the PowerPoints and PDFs because there was so much information that is definitely something that I need to go over and study even after the presentations, but it was a lot of valuable information. And I'm so happy that Jim was there too. It was nice. Had somebody else from our system there. And Jim, did you have any thoughts about the Berkeley presentation?
Yeah, I was going to echo your comments that I thought it was excellent. It was like 21 hours of Zooming, and I thought it would wear me out, but it was actually very, very educational and very engaging. So I'd recommend it to any of the trustees. I think one of the big takeaways, and it was probably the first 2 days of instruction, was on getting back to investments, and there was a lot on investment and simplification, and it kind of goes to my question to Callan about investable benchmarks and so forth, and what's happening in some other jurisdictions, what's happening up in Canada and so forth, and kind of in that vein, and going to some earlier comments, both from Kendall Smith and from Richard about focusing on these other fiduciary duties. It made me wonder if we're correctly balancing, or if over the last 40 years we've been correctly balancing how much time we spend in investments versus our fiduciary responsibility on the operational and benefit side. So just a thought, and maybe even a conversation for our strategic planning session. But otherwise, it was great.
Okay, great. Any other general board member items? Okay, not seeing any. Then I guess we could be adjourned at 11:29, and we will be meeting at our next meeting. Doris, our next meeting, do we have a meeting again in September?
Yes, the meeting is September 15th, if I recall correctly. Yes, it's on the agenda. That will be the last one before the governor's emergency order suspending some of the Brown Act requirements ends, unless he comes back and extends that due to the COVID surge. So we have been continuing to look at options for a return to in-person meetings if we have to, because of suspension, the expiration of the suspension of the Brown Act provisions. And we'll be continuing to look into the options for that.
Okay, great. All right, well then 11:30, we're adjourned.
Thank you. Bye.
Bye-bye.
Bye.
Take care, everybody.